please join me in extending a warm welcome to Miss Patni, Smita Patni. Please, over to you, ma'am.
Thank you very much, Pooja, for the kind introduction. So, a very good evening to all of you. Am I hearable? Am I audible?
Yes, Smita.
Good evening, ma'am.
Yeah, good evening. So, at the outset, I profusely thank the organizers of CASA team, including CA Sumit Gargji, our own Sachin Sinhaji, especially, for providing me an opportunity to share and present my views with our learned fellow professionals on this evergreen subject of Section 195, withholding taxes of non-resident, through this eminent platform. Now, with the increase in global trade, TDS on payments to non-residents has gained eminent importance in the recent years. The international tax landscape in India has underwent a significant and considerable change in past few years, with MLI coming into effect, the return of the classical dividend system, abolishment of dividend DDT, and with the extended scope of TDS under Section 195. Lately formed 10F, changing rates of FTS and royalty, Supreme Court ruling on MFN clause, playing on our nerves in the unforgettable calendar year 2023. So given the host changes of that the world, particularly the tax world, has undergone in recent years, we would like to make an attempt to analyze the impact of these changes in the compliance under Section 195. I will try to do justice to the topic accorded to me by bringing subtle nuances in the hidden layers of withholding taxes, and would touch base on the journey of Section 195 and more focus on the practical challenges of Section on Form 15CB and CM. So as it's a learning platform, I humbly request all the participants to pitch in wherever it is. I'll just share my PPT. So is it audible?
Yes, perfect. You can enlarge that.
Yeah, that's what I'm trying to do. I think it should be there, but it's not working.
यहाँ पर ये नाम लिखा हुआ आपका इसके राइट साइड में आ रहा है, राइट? या तो आप स्टॉप करके दोबारा शेयर कीजिए।
ये सबसे टॉप पे आपका आ रहा था ना स्लाइड शो मोड।
एक मिनट, मैं ऐसे करती हूँ उसको।
आशा कभी कभी ना डायरेक्ट शेयर कर दो तो आता नहीं है,
हाँ,
कुछ प्रॉब्लम आ जाती है।
हाँ, हमें मतलब यहाँ भी हो रहा था।
हाँ हाँ, वो यहाँ भी होता है, बट समटाइम्स इट इज नॉट हैपनिंग। ये कई बार फेस हुआ है।
That is what is happening। यहाँ पर तो वो कर रहा है मेरे को डायरेक्ट शेयर, पर मैं
आप दोबारा शेयर कीजिए, उसके बाद लॉन्च कीजिए।
अच्छा, पहले शेयर करूँ?
हाँ, पहले शेयर कीजिए उसे।
ओके। I think I am technically challenged, I feel.
No problem. आप मूव करके देखिए,
आपको होम बटन, हाँ राइट, जहाँ पे आपका माउस का कर्सर है थोड़ा सा ऊपर, ट्रांजिशन, एनिमेशन, देन स्लाइड शो। आपका माउस का कर्सर जहाँ इस वक्त दिख रहा है,
ट्रांजिशन, एनिमेशन, स्लाइड शो। ओके,
तो जस्ट क्लिक ऑन द स्लाइड शो from beginning on, or yes.
Yes, perfect.
Thank you so much. So as we I think one slide is going. There is one slide which is missing in this. If I am doing this way, I think is this better? This would help you.
Yes, ma'am.
I'll increase the
वापस वही आ गया, लेकिन कोई
मैनेजेबल,
इश्यू ना,
it's manageable.
मैनेजेबल। हाँ, राइट।
Right. So sorry, but I think because the slide is going. Yeah. So now just to give you the background of section 195. So section 195 is one of the most important sections and which basically deals with the non-resident taxation. So, in the complete bucket of TDS sections, this is the most eminent section. All the international transactions are routed through this section. Wherever withholding taxes is to be done, then section 195 come into play in the case of non-residents. This is not a new section. This is akin to the old section of 18B and 18C of the 1922 Act. So we have been seeing this section for a lot of, although there are a lot of changes which have been done during this section while section has come into play, but this section is not new to us. This is the only and the most important section whenever we deal with the provisions of taxation of withholding taxes for the non-resident. So as we know that, the world is going smaller and there has been a lot of international transactions and India has been a major market player. So we have to be very careful while making any payment and payment to the non-residents. And as there has been a lot of litigations also, lot of transactions also, and a plethora of cases going on this section. So let us start with the objective. So the main objective of bringing this section by the Income Tax Department was that non-residents, once the payment is made to a non-resident, generally that income is repatriated outside India. So it was, so the department wanted to collect taxes at the earliest point of time. That is at the first point of time, as soon as the income is accrued to a non-resident or the payment is made to a non-resident. So to ensure that the collection of taxes was done at the earliest point of time, that was one reason. Then the other reason was to enhance the liquidity of the income tax department. So they wanted to keep their liquidity maintained. So, the stakes are high in case of 195. Obviously, the withholding taxes are also high. So this would have retained their liquidity over the period. Third reason of bringing this section into ambit was that this is a checkpoint of any tax evasion. Since, once the income goes out of India, then there is no way to withhold taxes. So that is the reason this section comes into play, as this acts as a checkpoint for taxes evasion. Circular number 152, as already mentioned here, has brought out these objectives very clearly. The other important thing about section 195 is that for rest of the other sections, we have some threshold, some minimum amount until which no TDS is deducted. I'm talking of all the sections of 194C, 194J, 194I, whatever tax sections are related to the residents. 195 has no threshold. Even if you are making a payment of say 1 rupee, then you have to deduct tax at the very inception. This is considered to be, section 195 is considered to be final taxation or the ultimate taxation in the case of non-residents. For the resident taxations, generally for the other sections, we have assessments also, we have final assessments also. The withholding taxes for the other section is only interim taxation. So far as section 195 is concerned, this is considered as the final or the penultimate taxation. Even relaxation of ITR filings is also given in some of the cases if the TDS withholding is done as per section 195. I will come to it later. So now coming to section 195. So section 195 has overall 7 sections. So 195(1) is the basic section, which would tell you what all is covered and how the provisions of the section works. But 195, I will come back to 195 other sections later on. So 195(1) we are talking about. So I have divided the complete 195 into 5 buckets. So payer, payee, amount payable, time of deduction, rate of deduction. So reading the very first line, any person responsible for paying to a non-resident, not being a company, or to a foreign company. So any person would include all the payers, irrespective of being a resident or a non-resident. Any person as defined under 2 subsection 31. It has 7 categories: individual, HUF, company, local authority, artificial judicial person, firm. So all these categories which are there in any person is responsible for paying whenever any payment is done to a non-resident, then he is responsible for deducting TDS to that. Now, any person responsible for paying is also defined under section 204. So 204 has categorically defined who are the person responsible for paying. So in the case of individual, obviously individual is responsible. In case for the company, then principal officer is responsible. So on and so forth, they have defined in section 204 all the person responsible for paying. There is a new category which was added, that is agent under section 163. So that is recently being added in 2020 only. So this category is also added. So even the agent of a NRI or agent of a resident, he is also responsible for paying to a non-resident in case sum is chargeable to tax. So any person, all taxable entities are included. There is no exclusion in any person responsible for paying as per section 204, as I already explained. Now to a non-resident. So non-resident has two categories: not being a company or to a foreign company. So or to a foreign company means foreign company, and not being a company means an individual or any other entity. So foreign company as already defined in 222A or 223B. Non-resident as defined under 230. So resident is already defined under 2 subsection 42, which says that resident means any person within the meaning of section 6. Section 6 determines the residential status. Non-resident is defined under 2 subsection 30, which says that any person who is not a resident. For the purpose of non-resident, they have excluded RNOR specifically in the definition of 2 subsection 30 only. Only 3 sections are included, in which section 195 is not there. 92, 93 and section 168. So these three sections, RNOR is also included. For the purpose of section 195, RNOR is not included and it is excluded. Foreign company, the foreign branch of an Indian company is excluded from non-resident when we are paying, because obviously we are paying to ourselves. But similarly, Indian branch of a foreign company is included because we are paying to the foreign only. Foreign company has a PE in India, Indian branch. So we are paying to that. In that case, taxability will come. We are paying to a POEM, a foreign company who has become Indian resident by virtue of POEM. Then again, taxability will be there because it is a foreign company defined under 2 subsection 22. Read with section 223, 2 subsection 23A, which is a domestic company. So in this case, foreign company, any foreign company, even if it is by virtue of POEM also, then also TDS will be deducted in this case. Now, how to test non-resident payee, whether he's a non-resident at that point of a time or not. So this is a very important question for individual cases. So in individual cases, whenever we are paying to a non-resident, at the time of the test has to be done at the time of transaction itself or at the time of rendering services. So that point of time, this person, that individual should be a non-resident. The definition of non-resident specifically, we have to check out with the read with section 6 only. FEMA has got nothing to do with it. So the intention has no role to play in this case. The non-resident definition and resident definition has to be tested as per section 6 of the Income Tax Act. So the test has to be done for non-resident and at the time of payment only, at the time of transaction itself. There is a possibility that that we are sitting at the initial year of the just at the beginning of the year. Then also we will have to test the non-resident status immediately at that point of time, whether he was a non-resident at that particular date or not. Now, this is the definition of, this is any person responsible for paying. Now we read the second portion. So any interest, what all incomes are included or what all payments are included in it. That is the second part. Any interest not being interest referred to in section 194 LB, LC or LD, or any other sum chargeable under the provisions of this act, not being income chargeable under the head salaries. So now the payments have been divided into 2 sums, any interest and any other sum. They have excluded 4 categories in it. In interest, they have excluded 3 categories: 194 LB, 194 LC, and 194 LD. They have excluded 194 LB, LC, and LD because these are already taxable at a subsidized rate by the department itself. So they do not come under the ambit of 195. There is a bracket after 194 LC. There is not a bracket after 194 LD. I feel this is a typo error. The bracket should have been after 194 LD, and probably this 194 LD was later on added. So that is the reason the bracket doesn't lie. The section is as it is presented here. Then the other fourth exclusion is salary. Salary is already taxable under section 192. So therefore, it is excluded from the ambit of 195. But that doesn't mean that it is not taxable. It is taxable, but here we are not going to tax it. We are going to tax it under the respective section, specified section. So what all other is left is taxable here. So that is interest and any other sum chargeable to tax. I will come to any other sum chargeable to tax in a separate slide. For the time being, we understand that whatever sum, whatever income is chargeable to tax under the provisions of Act is taxable under section 195. At the time of credit of such income to the account of the pay, or at the time of payment thereof. So it says that whichever is earlier, that means credit. If we are following mercantile system, that if we are crediting the income, which is a thumb rule, then we are supposed to deduct tax at that point of time. If we are making the payment, then payment is done on the cash basis. That means that is done earlier than at that point of time. So whichever is earlier, if we are doing the credit or we are making the payment. So either of the time, whichever is earlier, we are supposed to deduct tax at that point of time. Now, the payment is to be done in cash or by issue of check or draft or any other mode. So it is saying that you can do the payment in cash, fine. Issue of check, okay. Issue by draft, okay. Net banking, okay. Now they are saying any other mode. So what we are saying, any other mode is that we are not making payment directly in either of the cash movements, either of the cash modes, or either through the banking channels. We are making payment through kind, through adjustment entry. So even that is taxable. For example, we can take an example of KBC, which is the best example. I understand that, for example, a non-resident in the KBC, if you win more than 1 crore or 5 crore, so you get a cash prize also, you get a car also. So if a non-resident has won that prize, so the taxability will also come for his car also. So for 1 crore rupees which he has won, obviously TDS will be deducted. Now for the car which he has earned in kind, the TDS either will be reduced, the TDS will be calculated, that withholding tax will be calculated. It will be reduced either from his cash price, which is paid to him, or either the KBC will bear it on its own, or it will ask the non-resident to deposit it separately, to give it to it, and then the KBC will pay to it. So any other mode, that means any other kind, even if that prize money is in kind, we are supposed to deduct tax. Other example, we can say that we do netting of transactions between associated enterprises and the Indian entity. So generally what we do, that there is a receivable and there is a payable. We set up that entry in the books. But in case that amount is there, we are supposed to pay that amount. So we are supposed to deduct TDS, deposit it to the government of India, irrespective of the fact that whether we have net of the entry in our books. So any other mode, for example, there is a very famous case of Kanchenjunga food cease. So it says that in this case, there was a trading done between the foreign entity and the Indian entity. So there were fish which was traded off. So the Kanchenjunga Seafoods gave off fish as a piece to them. So the department was very clear on this, that, you need to pay, you need to deduct, you need to pay the cash component, or you need to pay the TDS on that amount, irrespective of the fact that you have given the piece in kind, that is fish. So even if you have given the fees in kind, then also you are supposed to deduct TDS on that amount and deposit it with the government. So I hope any other mode is clear. Now it says deduct income tax thereon at rates in force. So now rates in force is defined under 237A subclause 3 of the Income Tax Department of the Income Tax Act. So 237A subsection 3 has 2 parts in it. Rates in force. So rates in force means rates as per schedule 2 part 1 of the schedule 2, or rates as per section 90, that is DTAA. Whichever is applicable, that rates would be applied here. I will come to rates in force separately also in another slide. So now there are 2 provisos to section 195(1). So the first proviso says that interest payable by the government, that is under section 1023D. So that will always be on the payment mode. The TDS will always be deducted in this case at the time of payment only, and no credit. This is a proviso to the main section. So no credit facility, that means no credit. In the case of credit, it will not, TDS will not be deducted. Only at the time of payment it will be deducted. There is another proviso which has been deleted now. That was for dividend. So now dividend payments are now taxable under section 195. So there are two explanations also. So explanation 1 says that interest payable account or suspense account, whatever account you name it. But if that amount has been credited in the books of accounts by whatever nomenclature you give, then TDS is supposed to be deductible at that point of time only. We are not going to wait for the time of entry because the bookish entry has already been passed. So we are not going to wait for this, that, you know, TDS is that the nature of that account is transferred to suspense account. Interest payable account, suspense account, whatever name you gave, once that amount is transferred to the book entry by the way of book entry, then we are supposed to deduct TDS at that point of time only. Explanation 2, which has now come into ambit and which is the rule of the law today. This has come because of the after effect of Vodafone. So it says that even if the payment is made from non-resident to non-resident, it was always taxable. As long as the payment is taxable in India, as long as the capital assets are situated in India, whether that non-resident who is the payer has a residence, has a place of business connection in India, it doesn't matter. Whether he has any presence in India, it doesn't matter. He is supposed to deduct tax while making payment to the payee. So I'll give you an example. Say there are in Vodafone, what exactly happened? There were two companies, say company A and company B and company C. So company B was the seller, company A was the buyer, and company C is a company located in India. So company B had shares sitting in its books, investments sitting in its books, which were situated in India. So the shares belong to company C. They were sitting in company B. Company B sold out these shares to company A. Since the capital assets were located in India or the shares belonged to the Indian company, so company B was supposed to deduct TDS while making payment to company A. So in that case, even if both the transaction is between NR to NR, that is non-resident to non-resident, but the shares or the capital asset is situated or located in India, in that case, we are supposed to deduct TDS. The payer, that is company A, was paying to company B. So company A is supposed to deduct TDS while making payment to company B, and then company B for the shares which was situated, because the asset was located in India. So that is what they are saying, that this explanation too, that even if the payment is between NR to NR, it doesn't matter. As payee can be anyone, as already reiterated that the payer can be anyone. So payer can be anyone. So it can be non-resident also or a resident also. So in this case, explanation 2 has been brought in the ambit. It has been brought in section 2012, where it has section Finance Act 2012, and it has been inserted with retrospective effect from 1962, saying that it was always clear payment between NR to NR is always taxable in India. Now, sum chargeable to tax, which we were discussing earlier. So sum chargeable to tax as already, sum chargeable to tax, we should start with section 4. So section 4 is the charging section. Section 195 is a machinery section. So section 4 says that whatever tax is to be levied by to an individual in that assessment year, it is determined by section 4. Section 4, subsection 2 always also give leverage to deduction of tax, TDS and the advance tax. So section 4 is the charging section. From section 4, we go to section 5, which defines the scope of income of the individual. That means resident or non-resident. In case of non-resident, whatever income is deemed to receive in India, whatever income is deemed to accrue or arise in India, falls under the scope of section 5 for a non-resident. Receive or deemed to receive in India, accrue or arise in India. Accrue or deemed to arise in India. So those 4 types of income for a non-resident, scope of total income, section 5 is a part of income, his income. Section 6 determines his residential status. So from section 6 has already reiterated that 232 subsection 42 of resident says that, we are going to, whatever is written as per section 6, we are going to determine the residential status of a person as per section 6. So section 6, we are going to determine the residential status of a non-resident. From there, we will take out his scope of income, and from there we go to section 4. Now, section 9 is a deeming income. So section 9 does nothing except that it changed the location, jurisdiction of the tax from outside to India. So section 9 is a deeming provision. It only shifts the location of that income which was lying outside to India. From section 5, which already says that, the income deemed to receive or income deemed to accrue or arise. I will not go into much into section 9 because that is not the topic of the day. But section 9 is a deeming section, and from there, whatever income is deemed to accrue or arise in India will fall under this. Of course, I will discuss that business connection later on, which was there in, previously in that 195. So section 9, from section 9, once we are clear that this is the income chargeable to tax. So this is the total income, out of which only that income which has profit element in it will be chargeable to tax. So first we are supposed to determine the income from section 4, section 5, section 6, read with section 9. Once we have understood that this is the total income of an assessee, this is the residential status of that person, then only we go to the provisional, we go to section 90, of course, to avail the treaty benefit if it is taxable in India or there, section 90, I mean, whichever is beneficial. But before that, that person should be chargeable to tax in India. So that determination only comes from section 4, 5, 6, and section 9. You have to understand that, and then only you can determine whether that income is taxable in India or not. So the first step to go to section 195 is that we should determine that whatever is taxable or whatever is chargeable to India. After that, only that amount which bears the character of income or that portion which has income embedded in it, that amount is only chargeable to tax as per section 191. So there are exclusions, for example, equalization levy. So that is exempt under section 10, subsection 50. It's a levy, so it goes out of this. We have pure reimbursements. If we pay, say, the pure reimbursement through our associated enterprises like travel, flight tickets, or etc. So that is pure reimbursement. We don't have to deduct any TDS in that. Payment to shipping agents under section 172, we don't have to deduct any TDS. If you are making any loans, if you are making any gifts, then no TDS is deducted. If it's a pure gifts, of course, there's a threshold of, there's a limit of 50,000 only for gifts to a non-resident. Then otherwise section 56 subsection 210 will come into play, but we are not going to do into that. What we are saying is that any sum chargeable to tax only will fall under the ambit of this. These exclusions will go out of this. So if this sum is chargeable to the payer, is supposed to deduct TDS on it. If it doesn't deduct TDS, if the payer doesn't deduct TDS, then he will be considered as an assessee in default. So then we will have consequences. We will go into the consequences later on. But assessee in default is a person where if the payer doesn't pay tax, then he will be considered as assessee in default for the purposes of section 204. And until unless if the payee pays taxes on its own later on. If the payee pays taxes on its own later on, then he will not be considered as an assessee in default. But otherwise, for the purposes of section 195, if he doesn't deduct TDS, then he will be considered as assessee in default for the purposes of section 195. There have been relevant CBDT circulars supporting this view. I will not go into all details of all the circulars. You can go through them. There have been majorly few Supreme Court case laws, landmark case laws, which support this view. GE India Technology was very clear. That was the first landmark case in which Supreme Court said that in order to determine that appropriate portion out of the gross sum, you have to go to section 195(2). You have to go to the assessing officer. I will come to 195(2). You have to go to the assessing officer for determination of that portion which is chargeable to tax. You will, if you can't determine, on your own. There have been, the same view has been taken by Transmission Corporation of India, that if there is even a bit of income embedded in the total income, then that sum is chargeable to tax. Now the only point is whether the gross sum or the amount determined by AO. If you cannot determine yourself that what is the income portion embedded in that total sum, then you go to the AO. If you are not going to the AO, then the whole gross sum is subject to TDS. That is sum chargeable to tax. Now we are talking of rates in force, which I was earlier discussing. So section 195 provides for rates in force. So we say that subclause 37A subsection 3, which I already said, that part 2 of the first schedule of the Finance Act gives the specified list of rates, or as per the rates as per section 90, whichever is applicable. So in the treaty DTAA, there are rates mentioned. So we can take those rates, or if those rates are not there, then we go to the income tax and we take those rates. Whichever is applicable, whichever is beneficial as per section 90 subsection 2, which says whichever is beneficial to the assessee, we go for those rates. There have been specific CBDT circulars for rates in force. So far as DTAA rates, so far as income tax rates are concerned, which are there in the specified Finance Act, it will be added by surcharge and cess. So there will be a cess and surcharge also in addition to these flat rates. So far as section 90 is concerned, that the DTAA is concerned, no cess and surcharge will be levied on it. There have been judgments on this. Even when you go through, when you read the DTA, it is clear that these are embedded of all cess and surcharge. These are the flat rates which are going to be put. So far as income tax India, when you are going to apply Indian rates, then you have to add cess and surcharge in these rates. There have been certain exclusions also from these rates in force. For example, if you go to apply for 195 to, that is, if you are going to apply for 197, that is lower TDS rates, 195 to 195.3 or 197, then obviously rates in force will not be applicable. Then whenever you are going to, if you have a TRC, then obviously you can go for a DTAA. I will go to TRC separately. So if you have presumptive incomes like 44B, 44BB, 44BBB, then again you need not go in this. I mean, the rates are separate mentioned for this. Then in case you have a notified jurisdictional area, Cyprus was there initially up to 2013, then they have rescinded that. So Cyprus was levied at if you are making any payment to Cyprus, then the rate was 30%. But now that notified judicial area has been rescinded. So Cyprus is no more a NJA, and there is no notified jurisdictional area as on date, section 94A. Then in case there are no rates specified. So we have entered a new financial year, and by any reason, there have been no rates notified. The bill has not been passed by the Parliament. So we go to section 294. So section 294 says that in case on April 1st, there are no rates, so we can take the rates of the previous year, whichever is beneficial to the assessee. This is in case of no rates has been mentioned or specified in the current year. So these are the exception to the rates in force. In case of payment is transferred from an Indian branch to a foreign branch, taxability is always there. Section 9(1) subsection 5 is very clear that whenever we are going to make to an Indian branch of a foreign bank or to its HO, then we are going to deduct TDS. So now that new thing which has come, or the new rates which have changed, is only of the royalty and FTS rates under section 115A. That is a part 2 of first schedule of the Finance Act. So as you all know that royalty and FTS rates have doubled in 2023 and 2024. Initially, the rates were 10%. So just to give you a background of these, that, if you can see that up to 2006, the rates were between 20 to 40%. From 1976 to 2006. In 1986, the rates were reduced to 30. Then in 1997, the rates were again between 20 to 30. Then in Finance Act 2005, again, the rates were between 10 to 30%. In Finance Act 2009, P. Chidambaramji introduced 206AA. That was, I will of course discuss that 206AA separately, that if you do not have a PAN, what is to be done. So there was this was a penal provision which was introduced in 2009. Then in 2013, again, the rates were increased from 10 to 30% to 25%. Mr. Chidambaram was the finance minister that time, and in the memorandum he said that the reason of increasing the rates was that there was an anomaly between the income tax rates and the DDAA rates. So to clear that anomaly or to bring at par both the rates, we have increased the rates. Again in 2015, at the time of Mr. Arun Jaitley, the rates were again reduced back to 10%, saying that to enhance or to increase the foreign funding in India for the young entrepreneurs. So the rates were again reduced. Now again, in Finance Act 2023, when the act was passed in February 1, there was no discussion of these rates. At the fag end of the year, that is on 24th March 2023, suddenly the rates were increased and there was no rationale behind it. But the fact of the date is that we have increased rates from 10 to 20% as on date. Now, 195, 2, 3, 4, 5, 7. So I have already said that section 195, 195.1 we have already discussed. 195.6 is for Form 15 CBCA. Rest of the sections, that is 195.2, 3, 4, 5, and 7, are basically application by an AO and CBDT furnishing making some rules in the prescribed form as how to apply for the lower rate. I will discuss it here. So for 195.2, so 195.2, in this, payer makes an application to the AO if he is unable to determine the sum chargeable to tax. That is determination of that portion which is actually chargeable to tax. So payer himself is unable to do so. So he goes to the AO. He makes an application in Form 15E. He says that whole of the sum is not income chargeable to tax. So please determine that portion of income which is chargeable to tax. So in this case, payer goes to the AO only for the determination of the portion of sum. In 195.3, payee makes an application for granting an nil return of withholding tax. So in 195.3, payee makes an application for the nil withholding, but in 195.3, it is only NR payee which would go, that is a non-resident payee. There are specified, it is for the specified class of people. So it is for the banking industry or the insurance company where Form 15C would be filed, or for the P or a person having a branch in India. That is a foreign company having a branch in India. So 15D. So 195 subsection 3 is only for the nil withholding. When it says that I want a nil withholding, then that these specified classes of people would go to section 195.3 to the payee making an application for granting a nil withholding. Now, in case of 195.2, I am saying payer makes an application, only the determination of the portion. No tax rate is decided here. In 195 subsection 3, rate, he is asking for a nil rate. He is not asking for the apportionment of the income which is to be determined. In 195, 197, it is open for both payer or the payee. It is open for payee, but both resident and non-resident. So in 195 subsection 3, only the payee would make an obligation, that is a non-resident payee, and that also the specified people, that specified companies, that is a banking company, insurance company, or a foreign company having a PE in India. In 197, any type of payee, individual assessee, or a foreign company, or a resident, or a non-resident, any payee for either the lower rate or the nil rate. 195.3 is only for the nil rate. 197, we generally go with 197. Form 13 is filed with this. It goes for a nil rate or a lower withholding rate. The rate is to be determined by the AO. So 195.2 is an order issued by assessing officer. 195 subsection 3 is a certificate issued by the AO, and 197 is also a certificate. So 195.2 order is appealable under section 248, but subject to 3 conditions: that payer himself is bearing that tax, it is payment of taxes has already been done, and payment is other than related to interest. If these 3 conditions are fulfilled and payer thinks that they are not able to determine that lower rate, so then this order is appealable under before CITME. So far as 195 subsection 3 and 197 is concerned, this is a certificate, so it is not appealable under 248. You can go to 263 or 264, or you may file a writ jurisdiction. So we can also explore a writ jurisdiction. So in case of Supreme Court Nestle MFN, only this writ jurisdiction was only applied for a lower rate. I will come to that MFN case also. So, but the writ jurisdiction was filed, and because 248 before CIT could not be filed in 195 subsection 3 or 197, as it's a certificate, it's not an order filing. I will come to this 15E later on when I discuss MFN, but 15E is to be filed by 195 too. At the time, 15E is a form which is to be filled by the payer while applying for 195 subsection 2. And for rest of the sections, I've already said 195 3, subsection 3, 15C, 15D. For 197, form 13 is to be filed. These all are online forms now. They were manual forms few years back. Now everything is online. Within 30 days from the filing of the form, the AO has to clear this form, or AO has to give the nil rates, or AO has to determine the rates. So once we file this form online, that is form 13, within 30 days, the AO is supposed to give us whatever the rates or determine the rates, and based on that, we can go ahead with the lower TDS rate, apply for lower TDS rate. So now grossing above taxes, 195A. So grossing above taxes, as we already know, so for example, Pooja is there. So now Pooja, say, she goes to Netherlands and settles in Netherlands. So now she says that I want some consulting service from Pooja. So Pooja tells me that, you know, I will charge, say, 10,000 euros for the services rental. So I tell Pooja that I will pay you 10,000 euros, but I will deduct 20% of it because my DDS rate in India is 20%. Pooja says, sorry, ma'am, nothing doing. You have to pay me 10,000 completely. It doesn't matter me what happens in India, what are the laws of India. You pay me 10,000 irrespective of anything. I say, fair enough, Pooja, I will pay you 10,000 rupees, 10,000 euros. So now what I do, I pay Pooja 10,000 euros. I know that I have to give the department TDS. So what do? I gross up this. So what I do is 10,000 divided by 100 minus 80 because 20% is the rate. So 10,000 divided by 100 minus 20 into 100. So I gross up that. So 10,000 divided by 80 into 100, that comes to 12,500. So my total sum chargeable to tax becomes 12,500. I pay Pooja 10,000, 12,500 into 20% comes to 2,500. I paid that to the government, TDS. So I deposit 2,500 to the income tax department. I pay 10,000 to Pooja, and my total sum becomes 12,500. So now what has happened is that initially, while we were doing grossing up, so pre-amendment, obviously the maximum grossing up which could be done was 10.92%. Now what has happened is the rates have doubled. Now the maximum grossing up or the amount that comes is 21.84%. So the excess cost or the delta between the highest rate and the rate pre-amendment is 15.68. So we are paying an excess tax cost of 15.68, which we are shedding from our own pockets. So it is very important that while doing these agreements, we have to check whether the agreements are net of taxes or gross of taxes. That is one thing. Secondly, if these agreements are net of taxes, we should take a declaration from the non-resident saying that he is not going to file an income tax return and claim those taxes back. If he claims those taxes back, he's supposed to pay us because we have paid it from our own pocket. Thirdly, if he is taking a foreign tax credit of those taxes from his home country, then we are supposed to tell him that we are supposed to know it. He's supposed to file a declaration that if he's taking a credit also, then he's supposed to give us our tax back. So these agreements, while doing the agreement only, we are supposed to take all these things into consideration. Otherwise, we will end up paying more. He will end up taking the credit of that or the refund of that. So I hope this 195 is clear. It is mainly on the grossing up of taxes. In grossing up of taxes also, we are supposed to issue the TDS certificate, but mind you that is different, that he is not supposed to use those TDS certificate, but as per circular 785, we are supposed to issue the TDS certificate to the non-resident. These grossing up taxes are not applicable on 192(1)(a), that is tax on monetary perquisites or not, which are not covered in 195(a). So I will of course tell the interplay of 206A with 195A, but first I will discuss 206AA. So 206AA, as already reiterated, was introduced in the year 2009. The main reason of this 206AA was that if there is no PAN with a non-resident, what do we do? So he lands up paying higher taxes. although the circular has come now where he is not supposed to pay the higher taxes, but at that time the penal interest or the penal charges were there that if he doesn't have a PAN in India, then he's supposed to pay the higher of the three. Higher of the three is the rate specified in the relevant provision of this act, rates in force or rate of 20%. So rate specified in the relevant provisions of this act is that 115A or 44BB or 44BBB or whatever, wherever the, or all the rates which are there in the presumptive sections, 112A, 115BAD, whatever the rates are there in the specified sections of the non-residents, or rates in force as already explained to you, or rates of 20%. Whichever is higher, he is supposed to pay that. Now they bought a circular and they bought a rule with 37 BC saying that, in case you provide these four documents, then, non-resident will be exempt from this 206AA applicability. So if you give the name, email ID and the contact number, address of the country of the residence, TRC and the TIN number. So in case you provide all these four things, then, you will not be charged with the higher tax rate, but you will be given the normal tax rate. Now coming to this, now 206AA. So this is so non-residents are generally exempt from this in case they provide all these four documents. In case they do not provide these documents, then obviously 206AA comes into play. Now hold on. So we talk of section 195A. We were talking of section 195A in the previous slide. We said that grossing up is done. Now the question arises is that in case of 206AA, then we are already charging a higher rate, 20%. And for the time being, for this year, it comes to 21.84%, 21.84% being the highest rate. Because obviously post-amendment, the rate has already increased. So it is higher than 206AA also. So are we supposed to gross up even if we are paying at the time of 206AA? When is 206AA applicable? Obviously, the higher rate automatically will be 21.84 if we are making a payment for FTS or royalty. In case we are making a payment for a PE, for a permanent establishment, business profit, then probably 206AA may come into play. 194 LC is already excluded from 206AA. 194 LD and LB is already excluded from section 195 only. But it is not specifically excluded from 206AA. 194 LC is excluded, and there is also a sunset clause in 194 LB, LC, and LD, which is up to June 2023 only. So obviously, LC and LB and LD we might still test 206AA, or in case of business profits, we may still test 206AA. So now I am saying that 195A comes into play. So we say that grossing up is done. So when we are testing 206AA, then grossing up is also to be done, and 206AA has also to be done. Are we supposed to gross up as per 206AA or not? This question is quite important in the case of business profits. Because for all other cases, it becomes redundant only. Because the highest rate is already 21.84 for financial year 2023. Up to financial year 2023, for financial year 2324. For financial year up to FY 2223, 206AA was 195A, and grossing up was playing a very crucial role. But for FY 2324, already the highest rate is 21.84 out of the three rates. So for grossing up, we say that, one view is that no grossing up is required in case we are paying if we are paying the taxes as 206AA. Because obviously we are paying at the highest rate, 21.84, or in case of business profits, 40%. Second view is that, grossing up is required vis-a-vis clause 2 only. That is rates or rates in force, because that is only defined in section 195. So we say that, in this case, we can still go with the view of, we can still do the grossing up because it is mentioning here also. Third view is that we gross up in all the cases. That is whether we are paying at rate of flat 20%, whether there's a rate specified in the provision of that, or whether rates in force. In either of the cases, we pay because we are grossing up. We have to pay from our own pockets. So whether this view stands correct or not, I don't think so. At least I don't agree to this view. I may still agree to view 2 that in case of rates in force, we may still take the view that, since section 195 refers to grossing up, TDS rates in the rate of force, so still we can go with the 206AA. Otherwise, in the case of grossing up, 206AA becomes redundant. Second reason of this is that, there is no direct cross-reference in 195A also and 206AA. There's no direct reference of either of the sections. except for the reference that in 206AA, rates or rates in force is there. That's the only reference which is from 195 and not from 195A. Second is 206AA generally stands redundant, as already said, post amendment FB, Finance Bill 2023. So now coming to evaluation of tax treaty benefits. So now we are saying that, section 90, obviously the rates in force have already been defined, that those are the rates in force as defined in schedule 2 of part 2 of schedule 1 in the Finance Act. Those rates are already there. Now we say that we have to take the treaty rate, because obviously as per the Finance Act, the rates have increased from for this financial year. That is 20% for specifically for royalty and FTS. So we want to take the treaty benefit. We want to take the lesser rate. So what do? We will have to evaluate the tax treaty benefits for those cases. Now, what are the documentation that is required in case we require or we need to take the treaty benefit? So there are 3 documents, that is TRC, Tax Residency Certificate, Form 10F, and no PE declaration. I will come to these separately also in separate slides. Just to give a basic information, Tax Residency Certificate, we are supposed to get all 3 documents in case we want a tax treaty benefit, in case we want to apply the lower rates. Now coming to impact of MLI. So we are also supposed to check that multilateral instrument that was introduced. So almost I think 40 countries in India where we have entered into multilateral instrument, where we have ratified and notified our DTAA as with these 30-40 countries out of total 95 countries, or I think 95-96 countries where DTAA is already there. So out of these 90-95 countries, at least with as far as I recollect, 32 countries or maybe 40 countries where MLI has already been, we have already entered or signed an MLI, ratified these countries for MLI. So we need to check the principal purpose text or the simplified limitation of benefit test, that is the impact of MLI while giving treaty benefit, whether there is any substance over form or not. So what do we do for that? We take a declaration from the payee that PPT test or SLOB test is met out while signing 15 CB. Now, obviously, we go to the payer because we are generally signing from the behalf of payer. So we ask the payer that please obtain a declaration from the payee, or if the payee is not ready to give, which he would generally not agree to give. So you go to the payer, ask him that please give us a signed declaration that, MLI doesn't affect while making payment. So this impact of MLI has to be seen. MLI itself is a separate, discussion. So I will not go much into that. Second thing is that the GAR applicability, general avoidance, anti-avoidance test, that this has to be seen. So section 90, subsection 2A, it's a non-obstinate clause in the section 90 itself. And it says that whether treaty benefit is there or not, if GAR is applicable, that is section 96 is applicable, if there is an impermissible arrangement only for the tax, then in that case, you will not be able to take any treaty benefit. Then automatically you go back to the domestic tax rate. So GAR applicability needs to be checked again. We have also a question of GAR applicability in tax audit. So we need to check that also. Then comes the MFN clause, most favored nation clause. So Supreme Court has recently, this is a very hot topic, and this is itself a separate topic, but I will not go into much detail, but I will explain what MFN clause is. So most favored nation clause is that, if there is a beneficial rate in one treaty, and if the other treaty says that, you will get that beneficial rate because there is a protocol in that Y treaty saying that you will, if the X treaty has got that benefit and you have become a partner, or if you have become, if the agreement has been signed in that way, that if that country gets benefit, I will also get benefit. So most favored nation clauses are there in some of the treaties. For example, there is Treaty A, there is Treaty B. So Treaty A was initially signed, Treaty B is later signed. So I say that Treaty A was signed with the benefit of, say, 10% only of the FTS clause. The rate was 5% on dividend, say, for example. Now Treaty B is being signed later on. So Treaty B is signed later on, where the rate is 5%. Treaty A was signed initially. So Treaty A said that in case there is any benefit which you will give later on to some other treaty also, so some other country also, I will also avail that benefit from that date, since you are going to give them benefit. So now Treaty B says that the dividend rate is say 5%. Treaty A or the country A will say, now you will give the same rate to my people also. So this is most favored nation clause. Now, what was the controversy? Supreme Court says that benefit of MFN clause will only be available if the protocol is notified. If the protocol is not notified, relevance of protocol is not notified, you will not get any benefit. You will not get any benefit in this. You will only get the benefit if the protocol is notified. Relevance of the timing of OECD membership was the another reason in which Supreme Court says that OECD membership has to be checked, that if he was not an OECD member at the time of signing that agreement only, then he will not get the benefit. So these were the two major controversies flowing around MFN clause. Now, how do we relate it to our 195? So I was saying that 195 subsection 2, you have to apply for a lower TDS rate, that you have to ask determination of portion of such sum chargeable to tax. So 195(2), when you say for the lower rate, when you ask for the lower rate, the form 15E has to be filed. If you can see, there is an extract of form 15 on this table. So it asks if there is a claim for make available clause, whether such clause in FTA's article is sought to be included in DTA through most favored nation clause. If you say answer is yes, they say whether notification regarding make available clause is issued by Government of India. You have to answer these two questions. These two questions are related to your Supreme Court judgment, which says that every protocol has to be separately notified by Government of India. Then only you can take the most favored nation clause benefit. So your answers will be based on that most favored nation clause. So you cannot take the treaty benefit on the basis of most favored nation clause if that protocol is not notified separately by the Government of India going forward. The MFN case was came in 19th October 2023. So this is MFN clause. Now coming to SEB. So SEB, I was discussing that there is a business connection. So section 9 explanation 5A says that we have to have a business connection in India. So for that there should be a P. But SEB is different. It doesn't say talk of any P. It doesn't talk of permanent establishment. It only says that if there is a significant economic presence of a person. How? They have defined some categories. They say that in case your transaction exceeds 2 crore or the number of users is 3 lakhs. If there are any purchase of goods or services by a non-resident, including the provision of download of data also. There is a systematic continuous soliciting of business activities. So in this case, there is a threshold of say 2 crore for purchase of sale of services, sale of goods, and there is a threshold of user threshold also which is exceeding 3 lakhs. So if you fall in these categories, irrespective of the fact that you do not have any presence in India, you do not have any business connection in India, then in SEP you are again taxable. Generally, nobody will come to you for 15 CBCA only, but for whomsoever you are issuing, all those companies which you are issuing 15 CBCA, it is important to tell them that in case you are purchasing any machinery, for example, or any goods from a non-resident which exceeds 2 crore, you are supposed to take 10F, you are supposed to take TRC from that company, because in domestic it becomes taxable as per section explanation 5A of section 9 going forward. I mean from last 1 year, 2324. So you are supposed to test this test. You can only, this transaction is taxable in India. This transaction gets only benefit from the treaty. So you are supposed to test this test. And I'm sure most of the chartered accountants, we will not even get this transaction because this transaction is directly rooted. But then you have to explain to your clients that, we require tax residency certificate, we require 10F for that person not to, for that person not to become taxable, because once he crosses the threshold of that 2 crore, even for the purchase of goods, even for the sale of goods in India, he becomes taxable in India. So please go through section 9. It's a separate explanation 5A and through SCP, and you will understand. This is not the topic of the day. Otherwise, I would have, we would have discussed it. Now coming to tax residency certificate. So tax residency certificate has already explained. Now we'll start with TRC. So TRC is section 90 subsection 4. It says that assessee who wants to claim treaty benefits in India as per the DTAA, then he has to bring a certificate of his residency from its home country. And the same has to be obtained by the government of that country, or the IRS of that country, or the revenue services of that country, or the income tax department of that country. If he obtains that certificate from the host country or from the home country where he belongs to, and he provides that certificate to the Indian payee, the Indian payer, then he will get the benefit of tax residency certificate. This section was introduced in year 2012. The reason of introducing this section was that we were taking the tax residency benefit without providing that TRC, and there were a lot of cases where actually he was not even a resident of that country. So to plunge that loophole, department made it mandatory that if you provide the TRC, you will get the tax benefit. If you don't provide the TRC, you will not get the tax benefit. But in addition to that, the memorandum also spoke that it is a necessary but not a sufficient condition for availing benefits of everyone. So it may be necessary, it is a necessary condition, but it's not complete in itself that even if you give the TRC, you may get the benefit. AO may still go beyond that. There have been relevant circulars supporting case laws that where it says that, TRC is not required. We have the scrap industry case, which is a quite famous case, and Ahmedabad ITA tribunal said that tax residency, if you don't have that TRC, what do we do? So they say that even if you don't have TRC, but if you can support, Morocco is one of the countries which doesn't give TRC. So in that case, we can provide supporting documents in support of our evidence that, tax residency certificate is there. That, these are the other documents which support our residency in that country. On the basis of that, we can avail the tax benefit. There is a specific circular 333 which was issued after Azadi Bachao Andolan. So Azadi Bachao Andolan is a land bar Supreme Court case, and it's a very old case. So it said that it was specifically for the Mauritius Treaty. So it says that even if the TRC is provided and there is no substance over form, but if a plain vanilla TRC, tax residency certificate, then no questions asked by that one. That should suffice that he is going to get the tax benefit. This circular was issued long back in the year 1982 itself. So that supported that tax residency certificate is the conclusive evidence for providing tax treaty benefits. After this scrap industry case, there have been more cases of Ranjit Kumar and Srinivasan Reddy also, which supported this view that even if you don't have a tax residency certificate, but if you can support your view with other documents that you are a tax resident of that country, you can still claim treaty benefit. But as on date, the rule of the law is that you are supposed to get the tax treaty benefit. Now, what are the issues that are revolved under TRC? So now timing of TRC at the time of credit or evidence. Now, as already mentioned in 195 subsection 1, that, the treaty has to be the time of the treaty, the 195.1 we have already mentioned that payment or the credit TDS has to be deducted at the earliest point of time. That is either at the time of payment or at the time of credit. So what time are we supposed to get that TRC? We are supposed to get the TRC at the time of payment or at the time of credit. The rule says, the technical language says that we should take the TRC at the time of credit only, at the first point, because we are deducting tax at that point of time. So if we need to have a TRC, we should have the TRC at that point of time. Of course, there are second view also that since we are making the remittance and the question is asked in 195 in 15 CV that whether TRC has been availed, this question is at the time of remittance. So can we say that, at the time of remittance, TRC should be there? So, there are both views, but the correct view to my view, the one option is that we should take the TRC for both the years at the time of making payment also and at the time of making remittance also. So for example, 15th March is the date of invoice, 31st March is the date of TDS, but we are making payment on 15th of April next year. So in this case, what do we do? Which TRC? We talk of TRC of 15th March, we talk of the TRC of 31st March 2023, or we talk of the TRC of April 15, 2024. So best option is that conservative use, they take TRC for both the years. If you don't want to take the TRC for both years, at least in the year where TDS is deducted, take TRC for that year. Otherwise, you cannot give the treaty benefit. Regular payment versus one-time invoices. So for group companies, generally there are regular payments. And there are one-time invoices also for some of the companies which are not on associated enterprises. So for the regular payments or where there are group companies, you can still, if the TRC do not pertain to the same year, or if they are saying that TRC will come in few months, or if they give you an application which is already there of TRC, then you can still give the TRC benefit because there are regular associated enterprises. But if there are one-time invoices, then you should be assured, you should take the TRC and then only give them the treaty benefit. Even for the regular payments, if they give you the declaration and you feel that TRC, generally that entity provides you TRC, associated enterprises, it's your regular group company, provides you TRC later on, you can still give them the benefit of the TRC that they can provide later. Now, there are TRC which are relevant for the full year or TRC not available. So, for example, TRC, this is calendar year versus fiscal year. So, generally what happens is that TRC is issued in April. TRC is issued in January. Our financial year starts in April. So, 3 months, block is there. So, there are two ways to handle this problem. One is that we deduct proportionate TDS. We deduct proportionate TDS only on that TRC, on that amount on which we have got the TRC. For the remaining 3 months, we deduct tax as per income tax. Second option is that if we have got the TRC for both the years, then obviously, we can take the benefit of complete, or otherwise we only make payment of that for which TRC is there. We stop the rest of the payment and we wait for the TRC to come. So now the period of issue versus the date of issue. So, what happens is that there are countries, for example, UK. So UK issues for the Australia issues for April, June till May 31st. So that is the period when TRC is issued for this period. So in Singapore, only the date is mentioned, specific date is mentioned. It's a loose-ended, open-ended TRC. We do not know for which period it belongs to. So generally, in such cases where it is not similar to our financial year and the period of issue or the date of issue is not clear, then in that case, we should only take the proportionate TRC for our calendar year. If open-ended date is there, then definitely we can assume that it is for the whole financial year. If open-ended date is not there, or from the date of starting, say 1st January, if it is written 1st January 2023, then we should assume it is up to December 2023, 1 year. But we cannot assume it that 1st January 2023 will end to 31st March 2022. Now, if the country of residence doesn't issue TRC as Morocco, so what do? Then obviously, we are supposed to rely on scam industry case. TRC is not in an English language, so what do? Obviously, there are 3 ways to deal this problem. One is that we go to the Google. Google is the best way. We can ask the Google that translate that. The authentic way is that second option is that we go to the payee himself and ask him, the non-resident, that kindly get it converted into an English language and please provide us the English version of this. If both the things are not happening, then the third option is, obviously Google will always work. Third option is that you should go to the approved English translator sitting in India and get the whole TRC validated or translated in India. This is specifically if the stakes are very high. Now DTAA is available. Now DTAA, we have to see that TRC is only, DTAA will only be applicable if TRC is issued. DTAA will applicable only for that country for which TRC is issued. For example, the invoice has been raised from Singapore and the non-resident has given a TRC of, say, Mauritius. So then in that case, we are supposed to take the treaty or the rates of the Mauritius. We are not supposed, because the tax residency certificate pertains to Mauritius and not the Singapore from where the invoice has been raised. So you have to be very mindful that the TRC has to belong to the invoice, or otherwise we are supposed to take the treaty benefit of that respective state from which TRC is issued. TRC can also be given at the time of assessment in case, obviously he is unable to provide TRC at the beginning of the at the time of payment, at the time of when at the time of deducting TSC, and the case has gone to assessment, so he can furnish TRC that time also. There has been a Mumbai ITAT case law for the same. Now, this support, this TRC section 90 subsection 4, this view is also supported by section 90 subsection 2, that provision of this act would be beneficial to are more beneficial to assessees. So even if we do not have the TRC, we can go to the scrap industry case, we can go to the department, we can go to the court of law and explain our case that, this is the reason for which TRC is not applicable. But as in a general parlance, we are supposed to issue the TRC. 10F. So 10F is the most hot topic, and 10F is one which obviously, was introduced just after section 90 subsection. It was introduced in the Finance Act 2013. So this was introduced in Finance Act 2012 TRC. 10F was introduced 90 subsection 5 in Finance Act 2013. So initially when this 10F was introduced, so the assessee, the language which was written was the same language which was written here, that it is a necessary but not a sufficient condition for availing benefits. So therefore 10F is to be provided. But later on, when they brought the final section, then the section read like this: the assessee referred to in subsection 4 shall also provide such other documents. So 10F is an additional document. It says that in case TRC doesn't provide all those 5 things, that is status, nationality, PIN number, tax period, and address of the assessee, then 10F has to be taken by the assessee. That was the initial documentation which was supposed to be. So 21AB rule says that 10F was only introduced in case TRC is not sufficient. Of course, today the law is different, but this was the major reason when 10F was introduced, and this is as per section 90 subsection 5 even today, that if these 5 things are not mentioned in tax residency certificate, then we file an additional 10F. Initially, 10F was a self-declaration form, and it was taken on the plain page by the signed and duly signed and stamped, or on a letterhead of the non-resident, that I am these 5 things are this, and he used to self-declare this 10F. Now over the years, especially now, they have changed. Now what did they do in 16 July 2022? They took out a notification suddenly that 10F has become online. And how online? You have to log in through the income tax portal. And how do you log in through the income tax portal? By the PAN. Non-resident doesn't have a PAN. What do we do? So this notification was introduced in 16 July 2022. After that, they extended it till December. Then they further extended it to 31st March. And then they further extended it to 30th September 2023. They kept on providing the relaxation, but with the conditions, with the 2 cumulative conditions, that person, that NR was not having a PAN, and NR is not required to obtain PAN only. If these 2 cumulative conditions are satisfied, you can still give the relaxation or the manual 10. But now what they have done to simplify things, and they have finally heard all of us. Now what they have done is that they have done e-filing of 10F in 2 different ways. One is the person who is having a PAN, and one who is not having PAN. So the person NRI who is having PAN, he can log in through this. These are the steps which you can go through. You can log in through your income tax portal through your PAN, and then you can file this 10F. Those who are not having 10F, they can also go through the income tax department to the web portal and go to that register button. In register category, there is an option of others. In that others, there is a category non-resident, not holding, and not required to have that. You click to that this category, and then you fill the relevant details. Relevant details are referred here, prerequisite of generating 10F. So you fill all those details, and then you can file 10F digitally, obtain a OTP. You don't have to have a DSC also for this. For filing PAN in going through the login portal, you need to have a DSC. For filing online 10F without login, you need not have an OTP also. You need not have a digital DSC also. You can just go through the OTP, generate an OTP of a non-resident and get his 10F fine. But this 10F has become the rule of the law. In addition to TRC, you are supposed to give 10F. There is no way out that you cannot give the 10F. Now, what are the practical issues? So, as already said, that this login without portal can only be done if you are satisfying two conditions, that is NR not having a PAN and he is not required to obtain PAN. If these two cumulative conditions are satisfied by NRI, that what he is saying कि भैया PAN कभी था भी नहीं और PAN चाहिए भी नहीं. So in that case, you can go to an online portal without having PAN. But if you say so, that you do not have a PAN, that is okay, but you are required to have PAN, then you are supposed to take PAN. So this is one controversy which is moving around. Second is that, as already reiterated, that if TRC contains all these 5 conditions, which generally happen in the case of US TRC. So US TRC is a 2-pager form. First page would give you the tax residency certificate, and the second pager will give you all these information: status, nationality, 10, tax period, and address of the assessee. No, US will not give the address of assessee, but in second pager, if you ask, they'll give you the address of the assessee. So in case you ask for all these information, US IRS gives you that. So are we still supposed to file 10F? Yes. Once it has become digitalized, we are supposed to file 10F irrespective of any. If we are supposed to take the treaty benefit, we have to file it. There's no other way out. So if now this 206AA has also 4 conditions, 4 pointers. So 2066A also says that if you provide these 4 things, address, certificate of residency, TIN number, and all, these are the same things which your 10F is, which your 21AB is also saying. So all these informations are going from here to there, there to here. But now, if you are taking the tax treaty benefit, so now 115A subsection 5 says that if you have deducted TDS as per the income tax rates, then there is no need to file ITR for those 5 cases, that is dividend, interest, capital gain, royalty, and FTS. You need not file the income tax return only because you are already filing the rate at 21.84 or whatever the rates are. But if you are taking the treaty benefit while giving 15CB, while issuing 50CB to a non-resident, then in that case, non-resident, in addition to that, is supposed to file his income tax return also under 115A subsection 5. So he has no choice but to take PAN. Because 115A subsection 5 makes him mandatory to file return. If the TDS is not deducted as per the income tax rates, as per the Indian domestic rates. So these are the practical issues. Of course, we have already seen the impact of DDAA on this 10F. Obviously, FTS payment, make available clause, MFN, since Supreme Court has come, we cannot take it. Then this engineering analysis, software licenses we were talking of. So software licenses, we can only take the treaty benefit because as per engineering analysis, it was still taxable because of the extended explanation of royalty, section 916. So it was already there that software licenses are taxable in India because of the extended definition, but they are out of the ambit of treaty because of the narrower definition of royalty in the treaty. But again, the benefit we can take only after providing TRC and 10F. Similarly, as already discussed about SCP, MFN clause, indirect taxation, indirect transfer of NRI to NRI, again, all benefits for the treaty can only be availed if you provide TRC and 10F. Then only you can take the lower tax treaty benefit rate. Otherwise, you have to deduct tax as per the treaty, as per the rate specified in the income tax. Now,
Ma'am,
yeah, please tell.
Ma'am, there is one query from a person, a company who earned YouTube income. Some tax is deducted by country. Is
I
it
will come,
possible to?
Pooja, let me just finish this and then I will come to all the queries. Don't worry, I will not do. Let me just finish it on. So we have some time now. We have another half an hour. So I will take the queries after this. So 15 CBCA. So now this is 195 subsection 6 we have. So 195 subsection 6, we say that, Finance Act bought this in 2008. It says that whatever the information was there, whenever we are making any payment to the foreign taxpayer, the same was to be reported by the payer to the department by way of 15 CBCA. The reason of bringing this section was that, one was that to ensure that everything is reported. It was a reporting mechanism which was bought as a tool so that we know that what all payments and to whom all are the payments made to the NRIs. Second reason was to ensure and collection of the TDS. As already know that, all the information is already captured by the department. So we know that this information and this TDS has already been deducted. Now, how did they enhance that? They said that now it was a manual filing initially. Then they shifted this manual filing to an electronic reporting, 15C and CB. They have specified a list of 33 remittances where still it is exempt. That is different that, whenever you go to your banker, they will ask for all the TDS for all the 15 CBCA. In addition to this, they also said that in case you do not report or in case you misreport, then there is a penalty of 1 lakh rupee. In case you furnish inaccurate reporting. So the assessee has to be very mindful in reporting this information and in a correct manner. So now how does this 15CB and 15CA work? So 15CA is basically divided into 4 parts. Part A, Part B, Part C, Part D. So whenever there is any remittance which is chargeable to tax and which is remittance during the year, which is less than 5 lakhs, so CA certificate is not required. So Part A says that if you are making any payment to a non-resident and if the total remittance during the year is less than 5 lakhs, maybe in, maybe in 3 tranches, 2 tranches, or in one go, whatever. If that amount is less than 5 lakhs, even if it is chargeable to tax, you need not go to CA certificate. CA certificate is not required. 15CB is not required. Part B says that in case, even if the income is chargeable to tax, it exceeds 5 lakhs, but if we have obtained a lower TDS certificate, as already explained in 195 subsection 2, 195 subsection 3, or 197, then in that case, CA certificate is again not required. We need not do anything. We issue 15CA. Part D says, I will come to Part C later. Part D says that if remittance is not chargeable to tax, subject to this note, I will explain them. If sum is not chargeable to tax only, if there are pure reimbursements, say for example, then CA certificate is not required, irrespective of the threshold, maybe 5 lakhs, maybe 10 lakhs, whatever. So now what are the sum which are exempt? One is obviously which are pure reimbursement, one example. Then they have divided 3 categories also, in which they say that these are the excluded categories which is not chargeable to tax and no 15CA is required. So they have a specified LRS or capital account transaction as per FEMA-CAT 2003 regulations. Then the new category which has been added is IFSC. If you are unit holder of IFSC and if any payment is made by IFSC to a non-resident under section 80LA, then again it is exempted from tax. Third is they have specified 33 specified transactions only, where 15CA is not required. These 33 category is here. So you can go through the category. So in these 33 transactions, 15CA is not at all required. Of course, on a practical note, if the banker asks you for a 15 CBCA, you have to issue it. We have no choice. Either we go and fight with them or we issue a 15 CBCA. Now, Part C. So Part C is when all is a residual category or is the category where when in Part A, Part B, or Part D, form is not met. So Part C is the category where 15 CB or a CA certificate is required. So in this case, when a sum is chargeable to tax, as already explained, remittance is required. Remittance exceeds 5 lakh. So if remittance is less than 5 lakh, again we go to Part A. Now, for example, there is a transaction. Part A is qua assessee. It is not qua transaction. So if there is an assessee for which we have paid 2 lakhs in one go, 2 lakhs in the second tranche, now we are paying the third tranche of 2 lakhs again. So now it has exceeded 5 lakhs. So it comes to 6 lakhs. So in that case, Part C is to be issued and taxability of complete 6 lakhs is to be done. Because initially up to 4 lakhs, we did not deduct any TDS because we issued in Part A. Now we come to Part C. So we have to deduct TDS on the whole amount of Part 6 lakhs. Initial of 4 lakhs also will be added here. So CA certificate is only required in Part C. Now, what are the contents of 15 CB? So 15 CB is divided into two parts, Part A and Part B. So Part A, obviously, name and address of the beneficiary of the remittance is there. The name of the beneficiary and all his details will go in the Part A. Part B has 14 clauses. Yeah, 15 clauses. So first clause is country to which remittance is paid. It is a drop-down menu. You can choose the country to which remittance is paid as per the invoice. Currency, again, it's a drop-down menu. Amount payable, that is what amount is payable will be reflected here in foreign currency or in Indian currency. Payable is sum chargeable to tax. So in foreign currency, in Indian currency, absolutely fine, no problem. In foreign currency, we go to Rule 26. SBI TTBR, read with Rule 115. So SBI TTBR, that is the TT buying rate as on date of the deduction, would be there. Now, how do we get SBI TTBR rate? So we go to the SBI Forex website. There the rates are there. In case we are unable to get those rates, then we go to the XCN website, or we go to the RBI reference rate. But as per the law, it is SBI TT buying rate on which the foreign exchange currency has to be determined. IFSC code, these are the bank details which we all know can be filled. Name of the authorized leader through which, the banker name, through which we are going to transfer the money. Bank address, obviously, we will give. Proposed date of remittance. So proposed date of remittance is the date of remittance on which we are going to make the payment. So generally, we can say, for example, the 15 CB has been issued today. We have to give the proposed date of remittance today. Now we know that the payment will be go after 5 days. So we can write the payment date of remittance after 5 days, but then the payment cannot go before that. Proposed date is the date on which, on or after the date, the remittance will go, but not before that date. So we can ask with the remitter or the payer or the payee that, what is the proposed date of remittance or on which date you are going to make the payment. So we can write that date. Name of the nature of the remittance. There are 64 transactions. The nature of the remittance is there. So these are the 64 transactions, 64 list of nature of remittance. Out of these, 63 are specifically defined. 64 is the residual category. If you don't fall in the 63 category, then you automatically come to 64th category. That is the other income. In 63, you have to be very specific. For example, royalty. So royalty comes on 47. Then you have software license which come on 51. So you have to see the invoice, you have to see the nature of the agreement, whether it is royalty or whether it is software license, because taxability will depend on that. If it doesn't fall in any of the category, you go to the other income. Other income, there is a drop-down menu where you can write the exact transaction or anything, exact nature of income. So now, after that, we come to purpose code on FDI. So as per RBI, there is a purpose code for which this transaction is done. So I have also given the list of purpose codes. You can go through the list of purpose code. If you do not understand the purpose code, the best way is ask your AD, authorized dealer, your banker, that please give us the purpose code, because now RBI, the banker, has become very stringent. In case you give the wrong purpose code, they cancel your 15 CB. You have to regenerate a 15 CB. So it is better if you do not know the purpose code, ask your payer or payee that whether purpose code, which is the correct purpose code. Now, in case the remittance is net of taxes, whether tax payable has been grossed up, already explained earlier what is grossing up. So if you have to say whether it is being grossed up, yes or no, here you have to write. Now, in case it is grossing up, so coming to 10, is remittance chargeable to, in case it is grossing up, then in our previous example, when we were making payment to Pooja, amount payable will be 12,500 here, not 10,000, because some chargeable to tax will come there. If not, now they are saying in clause 10, this clause 10 refers to the income tax, that is the domestic tax. So it says if remittance chargeable to tax in India, yes, obviously, then only we are filing 15 CB. If not, reasons therefore. Generally, 15 CB would only be filed if it is chargeable to tax, and it may go out from the treaty, that is different. But generally, 15 CB is only prepared in case it is chargeable to tax. Of course, there is a case that, there is a zero rate and still, clients ask you that please issue a 15 CB, although no tax is chargeable or zero rate, because you will get a benefit in the treaty, but then still 15 CB, if it is chargeable to tax, you are supposed to file this form. If remittance chargeable to tax, yes. If not, give the reasons. If yes, the relevant section of that, where you are charging it, what is the taxability? It's a very small line, very few words are there. So you can write section 195, read with section 9, or, wherever that clause falls or whatever the section is, you can mention the reference of section. Amount of income chargeable to tax, you give them the amount of income chargeable to tax. This is again 12,500. Tax liability 2,500 in the case of gross income. Normal case 10,000, tax liability will be 2,000. Basis of determining, you will have to give them that it was grossing up, or it was net of taxes, or it was without grossing up. What was the reason of giving this? If income is chargeable to tax in India and any claim is relief is claim under DTAA, obvious. So in this case, first question it asks is whether TRC is obtained. So we can only get the treaty benefit if TRC is there. In case TRC is not there, obviously we will get out of it. We will have to pay taxes as per the domestic rate. So this question only comes if there is a TRT. So whether TRC has been obtained, once we say yes, we can fill, specify the relevant DTA, specify the relevant article of DTA. In case we have taken a protocol benefit as per MFN, we have to write DTAA article so and so along with the protocol. Taxable income as per DTA, we have to specify. So 11 has got 4 portions. First is mandatory TRC. If you say yes, and if these all are, then you can go to 11A, B, C, D, depending on which. So 11A is for royalty. 11A is for technical services interest. It asks for article of DTA and rate of TDS. In case remittance is for business purposes, then we go to 11B. Whether such income is liable to tax, obviously we will have to ask that whether this income is a business income. Generally, case of P, where is a foreign companies, where there is a branch in India, then we will go to this. The rate is 40% in this case. In case of capital account, capital gain, we go to part C. Now the point is, in case of capital gain, TDS has to be deducted. We generally, in case of payment made to an NRI for an immovable property, one example is this: you make a payment, so this has to be disclosed here. Basis of arriving at taxable income has to go. But in case that NRI has obtained lower TDS certificate, you need not fill this form. That is a different issue, that if you will go to the banker, he will ask you to fill this form. But then you can say that basis of arriving at taxable income, the reason is that we have already obtained a lower TDS certificate. First, you can find that this form is not at all required because we have obtained a lower TDS certificate and only part C will be filled. Part B will be filled. This form is not required to fill, but still if he insists you, then you fill this form. Part D, 11D is a residual clause. When nothing comes in either of the information, no 11ABC, nothing is there, then you go to 11C. So it's a residual category. When none of the above categories, the transaction or remittance belong to none of the above categories, then you go to 11D. So 11D, specify the nature of remittance. Again, for example, guarantee fee, for example, gift. So all these will come here. So in this case, you have to specify the nature of remittance, whether taxable in India as per DTAA, yes, the nature rate, and you have to so on and so forth. Then you come to amount of TDS. So amount of TDS, again, it says in foreign currency and in Indian currency. Rate of TDS. Then they say whatever the percentage, as whichever is beneficial. I mean, income tax rate is also there, your treaty rate is also there. Whichever is lower, obviously, you will go with that rate. Then actual amount of remittance after TDS. This figure has to be in foreign currency only, not in Indian currency. Please be careful for that. Then date of deduction of TDS. Now, date of deduction, again, there is a possibility. There are 3 situations. In case the date of deduction, there are multiple invoices in that year from the same assessee. Same nature of agreement. Obviously, if nature of agreement is different, then obviously you have to file different 15CB. Same nature of agreement, same assessee. You make him part payment and 5 go. So if it is the same year, you can take the last date of deduction because the assessee says or the payer says, I am not going to issue 515CB. It is a cost effective to me. It is not cost effective to me. Second option is that you fill 515CA because date of deduction were different. So you fill 515CB. Third option is that obviously you have to see that, you have to see if the transaction is done this year, if the invoice is related to this year and situation is such that the invoice is related to this year and the payment is made next year, then obviously you will have to file new form 15CB. You can't fill the same 15CB if the invoices pertain to the previous year and the payment is made to the next year. So if invoices are same related to the same year, then you can still use 115CB if your payer doesn't agree to filing of your multiple 15CB. Then your obviously accountant name and your CA name and all these details will come. And then you can put your DSC because it's an online form. These are the specified list exempt from reporting. This is the list of nature of remittance, which we've already explained. RBI list, purpose of code is already there. Then we have steps for filing 15CA. So I will not go much into this. It is already there. But steps for filing 15CA, I will just give you one major thing that, 15CA can be filed through the login, through the TAN portal of the payer or through the PAN portal of the payer. That is through the income tax portal, through PAN or through the TAN. So if we are filing 15CB through the TAN, 15CA through the TAN, then we are automatically going to the file 15CB also, CA also through the TAN portal. If in 15CB we have mentioned TAN, then we go to the 15CA TAN only. So I will explain you. Here it asks the PAN in the very first category. We have examined the agreement, PAN or TAN. So if we mention PAN here in 15CB, then obviously we will have to file 15CA as per PAN. If we mention the TAN of the assessee or the payee, then we go to the payer, then we go to the TAN login of the payer. The login ID will be different for both of them. So you can file your 15CA from either PAN portal or TAN portal, but you can't do both the things. I mean, you can't file from PAN for TAN and for TAN for PAN. There are 2 ways to file this. One is online filing and other is the manual filing. So online, obviously, you file one by one as per this slide. And for manual filing, then what you do is that you download the utility, Excel utility. You can do bulk filing in that. You can fill all those forms and you can upload it bulk. The department after 2 or 3 hours will process all the forms, and then all the forms will be all the forms can be generated through single go. If you are doing online, then obviously one form at a time that means 115CB can only be generated. But the only problem is that if you do manual filing, that is a bulk processing, then once you upload it, after 2 or 3 hours only, you will come to know if there is any error in that processing. If there is any error in that processing, then obviously you will have to refill all those forms. So online filing, the benefit is that we come to know of our error immediately, but bulk processing, the benefit is that we can file multiple 15CB in one go. So these are the steps. Then we go to the documentation of issuance of 15. These are the standard documentation that we should have while generating a 15CB. We should get all this information from our payer. while filing a 15 CB. These are the consequences of non-compliances, which some of them I've already discussed. So 40 AI, I would say that, in case you are making a payment to a non-resident, even if that non-resident is situated in India, for example, you are making a payment to the NRI who into his NRO account, sale of immovable property. You sell it. He tells you that kindly transfer all the money to my NRO account. So in that case also, you are supposed to deduct tax. Now the point is, if you do not deduct tax, what happens? So even if the payment is made to the Indian account, that means even if the payment is made in India to a non-resident, then 100% disallowance will be done in 40 AI. If payment is made outside India, obviously 100% disallowance is there. Even if a payment is made to NRI in India, foreign company having a branch in India, you are making payment to him. So he is a non-resident. That Indian branch of a foreign company is a non-resident. We are making payment to it. If we only make a proviso and we do not deduct TDS in this year, then we are supposed to disallow 100%. Please be careful. Be careful about this. 202.01, I have already told assessee in default. So assessee in default will only be there if the payer has later on not paid the tax. So if payer did not deduct the tax and payee did not deposit the tax. So payer forgot to pay the taxes now or did not deduct the complete tax, but later on at the filing of ITR or at the time of payee has completely paid that amount, then in that case, payer will not be considered an assessee in default. This change has come recently. This amendment has come recently, only in the year, I think, 2023, FY 2022 and 23. Finance Act 2023. So we have to be careful for this. As I already informed, that penalty of 1 lakh is there in case you furnished wrong information in section 195. There is also an imprisonment in case of failure to pay deduct. So kindly be very careful that you have to deduct tax and you have to pay tax. If you deduct tax and you do not pay tax, then there is an imprisonment. So these are the consequences of non-compliances of section 195. We can also obtain refund of tax under 195. There is a set procedure for that claiming refund, but the only condition for taking a refund is that we actually deposited that tax in the government of India or that means to the income tax department. Then only obviously we can ask for the refund. There are certain conditions when the contract is cancelled, remittance is paid to a NRI, but the contract is cancelled by the NRI. There is a partial execution of the contract, or there are various reasons when you feel that you have deducted the TDS, but actually TDS was not leviable. So you can request the department that as under section 248 that refund of taxes is to be done as per the procedure. File an application with the AO within 30 days from the date of the payment. Give him that copy of challan and whatever annexures are there. The refund will be there, but subject to only the payment of taxes has been there. These are the common errors and issues while filing Form 15 CBCA. So revision or withdrawal of 15 CBCA can be done within 7 days. If UDIN is generated, then only 2 days, because UDIN is only for 2 days. So if UDIN is not generated, then you can withdraw this 15 CBCA in 7 days. Then there is a practical, filing of, if there is a practical challenge in filing of omission of filings. Obviously, if you have not done the filings, we have forgotten to do, then obviously you can file section TDS returns later on also. You can deduct TDS later on also. When you do 15 CBCA, then when you start filling that 15 CB form, then first drop down menu is the year on which 15 CB is related. So it may be previous year or this year. So if you have forgotten, I think the window is still open for FY 22-23. You can still go to the previous year and file your 15 CBCA today. Else you can file it in the today year, but do not miss out filing 15 CBCA as it is important. Withdrawal, I have already said about UDIN. Issues in PAN and TAN, I have already explained you that PAN login or TAN login. Year of online filing, explained you that there are practical challenges. Refund due to cancellation, already explained. Option to gross up, already explained. Issues with TRC, we have taken up. Person signing 15 CA, obviously there are authorized signatories. So the person whose authorized signatory is there in that income tax portal, that person DSC is all to be put. It is not that the authorized signatory is somebody else and you put the DSC of somebody else. Please be mindful for that. Deferred payment or no payment after the issuance of certificate. Now, for example, you issued the 15 CB and no payment was done. You do not know. So I request that the payer should maintain a complete login of all those 15 CB. The CA should maintain the login of all 15 CBs issued by him. The payer should maintain all utilized and unutilized 15 CB or CA by him, so that he comes to know that the 15 CB and CA are there. Where remittance is made to, obviously I've explained you that you have to go with the TRC, that you know in which country the remittance is made to, and that drop down menu, and whether it is the invoice pertains to the same TRC or not. RBI purpose code, as already explained, that you know we have that list. SBI TTBR, I have already explained that if it is not there, then you go with the XCN rates of the RBI reference rate. Payable tax, payments taxable under the Act but exempt. So part C or D. Obviously, part D would be filed. I am talking of equalization levy, one of the example, 10 subsection P. So sum is not chargeable to tax, exempt. So we go to part D because it is exempt from the tax. So sum is not chargeable to tax only. So we file part D. Indirect transfer of Indian shares where two non-residents are involved. Now here comes the problem. So there are two non-residents. So TDS has to be deducted. As already explained because of the Vodafone ruling explanation 2, that if there is a transaction between NR to NR and capital asset is situated in India, we are supposed to file NR. We are supposed to deduct TDS. Now, how do we file 15 CBCA? So generally, these non-residents have a TAN login because they have to deduct TDS. So if they have a TAN login, we can file through TAN login. 15 CBCA can be generated. If they do not have a TAN login, then we are supposed to request them to take a TAN, and from there we can file 15 CBCA. But it is mandatory to file 15 CBCA. These are some of the common concerns in transaction. Reimbursement of expenses, already explained. If it's a pure reimbursement, no problem. We go to part D. If it's a reimbursement with markup, for example, country Y has done some expense on our behalf and it charges us for that along with the expense and also a markup. So in that case, we are supposed to deduct the TDS. Part C will go. Transfer of funds from NR to NRO. Generally, we do not issue 15 CBCA, but then every time you go to the AD, authorized dealer, the banker, they will say, please give us the 15 CBCA. We need a 15 CBCA for that. Equalization levy, already explained, part D. Some exempt to tax, some not chargeable to tax, so part D. Loan and advance, again, it's an LRS. It's a capital transaction, so obviously part D. Or no 15 CBCA will go, since it's an exempted category. When remittance are made in kind and transfer, then again we are supposed to issue 15C because TDS will be deducted. Part payment or advance payment, again TDS will be deducted. So we will issue as per the nature of remittance, part C. Payments from BO to HO, again, if it's a foreign company, Indian branch, TDS has to be deducted. Payments made through SBLC, BC outside India, if it's a buyer's credit, again, if it's a capital account transaction, no 15 CBCA. Use of credit card. So credit card is an important transaction. In credit card, generally what happens that most of us makes payment of trainings and everything through credit card. In that case, generally payments are made and we do not do anything. So what do we do? Income tax department says, irrespective of the fact whether you make any payment through credit card or anywhere, I need my tax. So what we do is that we go to the grossing up. We gross up that credit card payment and we deposit that tax on behalf of that. Or we deposit that tax. So far as 15 CBCA is concerned, there are two views on it. One is that 195 subsection 1 says that TDS liability is completed. So we have done that. So are we supposed to issue 15 CBCA for that? Because we have no details. We have made through the credit card. So whom do we issue 15 CBCA? So there is one school of thought which says that no requirement of issuing 15 CBCA so far as TDS deduction is done. There is another school of thoughts which says that you take the details of that bank account or from which transaction is done to the payer, to the payee, and from which the credit card payment is made, you take that BSR code of that and you issue a 15 CB and you keep it with you. So there are both views. Of course, AO will only decide which view is correct, but chartered accountants can opt for both the views. Sale of immovable property already explained, but I will explain this. So gross consideration in case of there is a property sold out by NRI to resident. So resident has to deduct tax on the gross consideration of the property until unless it has applied for a lower TDS under 195 subsection 2, 19 or subsection 3. Though we know that only the capital gain portion is taxable, but as per 195(1), the plain reading says that you have no choice, buyer has no choice but to deduct tax on the complete gross consideration. If the NRI feels that there is a loss or the capital gain is only so much, then he can very well go apply for a lower TDS certificate under section 197. And from there, if that is there, then buyer can obviously deduct tax at a lower payment of salary under 192. So already said that TDS is deducted under 192, so 195 has got no role, but 195(6) has got a role in this because we have to declare this. Now there might be two types of condition in this. One is that expat, generally expats comes to India and the amount is transferred to its overseas account. So the company transfers that amount to his overseas account. He's a tax resident, he's an expat in India in the first year. So in that case, 192 is already deducted. Part D, you can issue Part D because TDS is already deducted. Second case is when that expat himself transferring from his account to the Indian company pays his salary to the expat to his Indian account. From his Indian account, the expat transferred this salary to his overseas account. In that case, he is not required to issue any 15 CBCA. That is different. That banker will say that please issue a 15 CBCA. Third thing is in the second year, when expat becomes a tax resident in India, then automatically his TDS liability comes in India only. So that liability comes as per the domestic tax rate. So that only the repatriation of that amount goes to the account. So in that case, again, Part D can only be issued. There is no requirement for 15 CB. And any which way is 192, TDS is deducted under section 192. In case still, there is a contrary view, although I feel that, Part D is suffice, but otherwise you can also issue a 15 CB, say that TDS has already been deducted under section 192, and so there is a zero tax here. And then on the basis of that, Part 15 CA can be issued. In case, you want to apply, if you want to go for a very conservative view, then you can do this also. Issue a zero rated 15 CB saying that, tax is already deducted under section 192. So no tax is deducted here. The same thing can be done in case when, the capital gain is there. Lower TDS is applied and there's a nil rate, for example. Then again, you can go for this is in case of transaction of a share transaction. So again, you can go for the 15 CB zero rate, and then you can say that, tax is not there, but because we have obtained a 195(2)(3). In case banker pursues you or banker forces you that you have to give 15 CB. Otherwise, Part C for lower TDS or Part D for this. Now, remittance in case of payment by R to NRO on account of rent dividend to NRO, again, Part. So if it is taxable, again, Part C will go. If it is not taxable, Part D will go. Generally, TDS is deducted. So when we transfer to NRO account, from NRO to NRE account, when we are transferring, obviously no TDS, no 15 CBCA is required. Again, as I'm reiterating, the bank will ask you, so you have no choice but to issue. Although you can go and fight, you can explain them that 15 CB is not required, only 15 CA is required, or nothing is required, because this is a transaction which is outside that bank. Then there's a transfer from resident, non-resident, and the same results in capital loss. Again, 195 subsection 2 or 3 will we apply for the lower TDS, then Part C would Part B would go. Payments exceeding 5 lakhs on which order is obtained, Part B. I think with this I'm done. Now you tell me.
Wonderful, madam, wonderful. And wonderfully you have covered this long topic in concise manner. Any query, if it is there, then Pooja, you take up, otherwise we'll conclude soon.
Any query from the members? एक मैम एक query है. A company who earn YouTube income, some tax is deducted by source company. It is possible to stop reduction of tax via TRC or any way?
No, can you
Hello?
come again? What did you say?
Yeah, रंजन कुमार जी की query है. A company who earn YouTube income, some tax is deducted by source company. It is possible to stop reduction of tax via TRC or any way?
He's a resident of India.
Ranjan ji?
If he is a resident of India, he can always apply.
Yes, residents of India. Yes.
So if he is a resident of India, then there is a form 10B, I think, 10F or 10FA. So you have to fill that form. You have to go to the department. You can give that tax residency certificate to that YouTube and tell them that you are a tax resident of India. So this form will be this form. You can go to the income tax department and obtain from them that saying that I think this is 10F, 10FA. So you go to the income tax department where your jurisdiction lies, I mean where you file your return. To that jurisdiction you go, you tell them that you are a tax resident of India and they will give you the TRC tax residency certificate of India. You can give that certificate to the YouTube and then you can go with that.
Okay, ma'am. Thank you. And ma'am, एक query है मेगा जी की. Ma'am, if TRC submitted but not form 10F, then in such case, would treaty benefit can be availed?
No, already explained. No. Law
Okay,
says,
already
of course,
explained.
you can go to the court as already explained. So far as law of the land says, it says that 10F has to be filed now digitally. But still, if you
Okay.
think that, your case is your TRC contains all that information which is there in 21AB, then you can always go file a writ jurisdiction, go to the court. Court will determine because we already have a favorable case of scam industries.
Okay. Thank you, ma'am. Anyone have any query?
Yes, Pooja. Yeah, hi, Smita. This side, Himanshu. I have a query with respect to software subscription. Like today, there are many foreign companies from where we are getting software subscription on annual or monthly basis, like Bittrex, Notion, many more. And all the payments are done automatically via credit card on a monthly basis. So how do we comply in this scenario with respect to 15 CACB or with respect to withholding taxes? Because the concept of gross up, ultimately, it's loading my P&L only with that gross up cost.
So as I already explained to you about this credit card, software payments so if we are withholding taxes on software payments, then in that case, and we are making payment through credit card, and if we are making complete payment, that means we are not withholding any tax, then that amount of TDS we are supposed to deposit to the department.
Sorry to interrupt, but यहाँ पर attract होगा because software subscription जो मैं ले रहा हूँ in yesterday seminar it was mentioned by the other teacher that copyright versus copyright content.
So
it's a sale of goods, not a sale of service or something. So it's outside the royalty purview.
So engineering analysis was the Supreme Court landmark case, which was there in March 2023.
Okay.
So that case said that section 195, if you fall under the extended definition of royalty, where all type of software, whether it's a purchase or anything, it will be taxable in the domestic income tax. You can get a benefit because the definition of treaty is narrower. So the benefit you will get only in treaty. You will not get a benefit in the domestic tax, to my view. Engineering analysis of India, that Supreme Court case law was very clear. Though it is taxable, but because there was an extended definition of royalty which was brought into the ambit from Finance Act 2012, which said that, downloading, uploading, software purchase, explanation 5, 4, 5, 6. If you read all those explanation of 916, you will get that feeling that software license, irrespective of the fact that there is no copyright, still it is taxable in India, and you can only get a plea in the treaty. At least that is my personal view.
Okay, so to summarize, it will be considered as royalty in domestic law.
So I always
subscription.
think that there is a separate 51 clause where you can write it is software license, but then you will always get a benefit from the treaty. So for that, obviously, you will have to obtain TRC, 10F and all that.
And that's a practical challenge because इनका कोई POC नहीं होता है, सब online softwares हैं, so we are not able to get the TRC or 10F or no PE declaration from them.
So that in that case, you have to deposit TDS.
And that to 21 point something
84.
percent.
21.84, because that is the rate prevalent today.
That's a pretty high amount on my PNL then.
I mean,
Okay, thank you so much.
So-
That's my only question. Thank you.
So I think there is no other query, Pooja.
Ma'am, can you please share the PPT all members said about
Yes,
this?
yes, definitely. Smita ji
Thank you.
will share the PPT and I will share the recording also to all participants.
Okay.
And
Okay, thank you
Sachin
so
ji, you want to say anything before concluding?
In fact, no words to say, sir. Ma'am has already covered so many things, and that too in very detailed manner.
Detailed manner.
And I
Like,
think it's a Virat Kohli 50th century like session.
likes.
So, so thank you so much, ma'am, for giving us such a wonderful presentation,
Presentation.
covering all the aspects relating to international transaction, and also whether the taxability would be there or not, and the practical application like filing of form Part A, Part B, Part C, Part D, and covering all the queries of the participants. Thank you so much from my side, sir. Thank you so much.
Thank you, Smita ji, and thanks to all participants for joining and sparing your valuable time, 3 hours today and 3 hours yesterday. And definitely we are going to share tomorrow all the 4 presentations and video recording. So with this, closing today's session. Thanks
you
to
so
Pooja
much.
also.
Thank you so
Thank
much.
you so much, sir. Thank you so much, ma'am. Thank you so
And
much.
I would also like to express sincere thanks to Sachin ji, because in the morning I had been discussing with him almost for half an hour or 1 hour on a lot of queries, which we have deliberated now. So special thanks to him for that.
Thank you,
so
Sachin
much.
ji. Thank you.
Thank you.
Thank you to all. Thank you.
Thank you.
Thank you so much, sir. Thank you.
Thank you.